Hello, Jeremy Finger here, certified financial planner and certified investment management analyst. I am here with John Nickel, certified financial analyst with Stratus Investment Management. John has been in the industry for a very long time. You can tell by the gray hair, right? 30
Thinning
plus
gray
years,
hair.
I think. Yeah. 30 plus years.
Yep.
He graduated from Ohio State University and got your master's in Ohio State. Is
Yep.
that right? Okay, perfect. So welcome, John.
Thank you.
Yeah, great. So John, tell us a little bit about, a lot of the topic right now is about interest rates, whether it be buying a house, buying a car. And as you know, interest rates do affect the way the economy runs. So what's your outlook on interest rates? What's the market scene? How does y'all's opinion maybe differ? And what do you see going forward?
Sure. Well, when we entered the year, the markets were pretty excited that the Fed, which has had rates pretty high to defeat inflation, was going to finally start cutting rates. And there were expectations that the Fed was going to cut rates about 6 times or plus or minus that number. We actually here at Sims never we thought that was a very aggressive number. The only way you'd get cuts to that magnitude would be if we went into a significant recession, which we can talk about the economy right now. That's actually part of the good news is the economy is so good that the bad news is the Fed doesn't need to cut rates. And so what's happened is what you've seen is that the expectation game has been that rates, instead of having 6 to 7 cuts this year, is gone to 1 to 2. And it came to the head last week, and the market started to realize there was actually whispers that maybe the next move for the Fed might have to be a hike. And that's why you saw the significant hit to NASDAQ and all the growth names last week. Now, we're not thinking a hike would is possible right now, but we do think the economy's fairly strong. So we think the 1, maybe 2 rate cuts is probably more in line. So that risk that we had in the market, that expectation game was so high in rates, I think we're still looking for 1 cut this year. But the question will be, even though if the Fed cuts, the long rates fall. Because sometimes, the Fed can cut the short end, but the long rate might not fall. So it might not help the mortgage people in trying to get new mortgages and stuff like that.
Okay. So that's a great point. Well, why wouldn't mortgage rates fall if interest rates are cut?
Well, because when the Fed cuts rates, they're cutting the short end. They're cutting the Fed funds rate. So that's the short end. Interest rates are set on the long year, like the 10-year. And the 10-year does track the short end, but there's factors like global economies, the economic strength, the auctions, the fact that the federal government is spending money like a drunken sailor. So there's a lot of things like that cause the 10-year to act a little differently than the short end. Historically, when the short end falls, the long end does fall. But remember, we're still in an inverted yield curve, which is usually a sign of a recession. It hasn't happened this time, but short rates are higher than longer rates, and that's called an inverted yield curve. So we're thinking the short rates come down, and it comes back to a more normal, regular curve where the higher rates and longer rates are higher than the short rates, but that just hasn't happened yet.
Okay. Well, you said the word recession. Do you see anything out there that would say that we're heading in one, or do you anticipate one?
Let me be completely blunt. I'm shocked. If you would have told me 2 years ago the Fed was going to raise rates 500 basis points, I would have said, how bad is the recession? This economy is spectacular. I don't know how else to say it, that it's been able to absorb that hit. I do think some of that is a result of the billions upon billions of dollars the federal government has thrown at the problem and continues to throw at the problem. And so I think that's been the shock absorber that lifted the boat from going into a recession. What we're seeing actually this is earnings seasons right now. We see reports from like American Express had a great number. General Motors just blew out their number. You can't go into the recession when General Motors, who's producing cars, is saying it's a fantastic time. So that's one of the reasons why I would say, a cautious bull. we still think there's some expectation games out there, but we think the economy is strong. We think job growth, although it's slowing, it's still strong. And so those are two very big positives that will help earnings. I mean, the other problem we have with the market, if I'm looking for problems, is the market solved the first one. We didn't think there were going to be 6 cuts, this year in the Fed funds rate. The market is also expecting a 12% increase in earnings. Now, usually you don't have double-digit earnings increases unless you're coming out of a recession. But what's going in the analyst numbers right now is about a 12% expectation for this year and about a 15% expectation for next year. So that's what's baked in the cake of the valuations. That's a little strong for me. Let's put it that way. We still think because the economy is strong, we're going to have a positive number. It just might be 4, 6, or 8. It's not going to be 12, 14, or 15. And so we're trying to sit there and say, that's why we're trying to get a little more positive, because the economy is strong and earnings are going to be positive, but we're not all in until we get that expectation of the 15% growth rate, pulled back a little.
Okay. All right. Good point. In that, you're expecting your expectations is that the growth rate may be a lot less than what the market may think.
Right. We're going
okay.
high single digits, no recession, high single digits. And so that's a positive influence. The other thing, when you look at, how the stocks or indexes go up, they go up with earnings and they go up with valuation. Good news, bad news, unfortunately, valuations were already at basically, I would say, historic highs. So we're probably not going to get a multiple increase that will help move things up. It's going to have to be through earnings.
Okay. Well, that being said, how do you position portfolios if your expectations are different what the market is? Like you're a bit more cautious in that regard. How do you position portfolios if in this environment?
Well, I think the key word is diversification, because you don't want to bet on one sector. But the thing we're looking for is companies that are growing earnings, whether it's a tech company that's growing earnings or whether it's an industrial that's growing earnings. So it's not that we're saying, oh, this sector over that sector. We're not thinking we're going to go into a 20% correction, so we don't necessarily need to buy defensive stocks like utilities or staples. But there might be a utility or staple company, a consumer staple company, that's growing earnings at 10% that looks attractive. And so we will buy that type of company. So it's much more of a bottoms up, looking at the companies and what their earnings growth profiles are is what we're doing right now. And that's what sort of we're adding to. There's some positive names in industrials. Actually, some of the tech names, to be honest, are getting interesting with this pullback. I mean, some of them are looking potentially attractive. My whole problem with the semiconductor area is I believe AI is completely, going to be there and work, but semi is cyclical. So at some point there'll be an up and a down. I mean, people, if you go back to 2000, the number one tech stock was Cisco, and Cisco was the foundation of the internet. And so as you think about that in 2000, what is the internet? Oh, it doesn't matter. Cisco's going to build it for you. And Cisco's stock went up, I think, 800%. Of course, if you would have bought Cisco at that point, you're still not above water in that stock.
Do you have an idea of how many managers out there have flexibility as far as being able to, use alternative investments or use cash positions? There's a lot of mutual funds out there, and obviously the index as a whole, they
don't have that, right?
They don't have the flexibility of being able to play the defense like you guys do.
I would say coming from I used to be a portfolio manager at very large, one of the top, let's say, 6 fund families. And you had to be fully invested at all times. That was sort of the rule. So you had to be 1 or 2% cash if you thought the markets were going to go down 20%, or if you thought the market's going to be up 20%. That was so there's not a lot of flexibility. That's one of the big positives when you come to a smaller investment firm and you work with partners like you, that there's flexibility for the client. We can customization the portfolio to get exactly the risk reward that client wants or needs.
Yeah, no, that's a very, very good point. And speaking to that, it's like when you're taking income, when you're dealing with a retiree and they're taking income, downside risk is very bad. So trying to mitigate that risk, which is what you guys tend to do, are able to play defense. That really makes a lot of sense. And if any of the listeners or viewers out there want to take a look at what sequence of return risk looks like, we have some blogs on that. Do you see any like unusual tailwinds or headwinds that you haven't discussed just yet as it relates to the
I would
economy?
say one domestically and one international. So let's do the international one first. We're all aware of the Ukraine area. That's an issue. We're all aware of the problems going on in the Middle East. China's, I would say, is a concern. Not, yes, there's always the Taiwan concern, but I'm not going there. We're still wondering where the Chinese economy is, because it hasn't come back since COVID. When Europe and the United States came back from COVID, their economies basically went back to where they were or better and strong and contributed to the growth toward the global economy. The Chinese economy has not done that. Whether it's their commercial real estate, whether it's their demographics, whether it's the fact that they're supporting Iran and Russia, and so Europe and the United States aren't putting capital with them. That could be an issue. That China's just not growing like they used to, and that has a wave effect throughout the global economy. Commodities aren't as hot as they used to be. Global growth isn't what it used to be. So that's a concern that we have, that China's not the engine of growth that it's been for the last 15 years. So that just makes the whole system a little more, put it this way, United States better grow. Because if the United States is not growing and China's not growing, it's not going to be a nice global environment. So that's one in China. The other one is just the election coming up. Not that what I'm saying, the election and how it impacts the Fed, because there's a lot of press, a lot of numbers out there that says the Fed tries not to act during an election season because they don't want to be like they're favoring one over the other. So it's like, are they going to cut rates 2 times before the election? They have it in the past. So that, so the issue is that means they have to cut this summer. But if the economy is strong, they can't cut, or they shouldn't cut. Let me put it that way. So there's the politics is one thing. And on top of that is the politics will impact, especially in the energy or in the environmental area, in the industrial area, one versus the other. Obviously the green technologies with one president and maybe energy stocks with the other president.
Okay. A couple points there is China not, maybe you talk about Europe and United States maybe not investing in China. Is that, you think that might be because we're trying to insource a lot of things?
I think it's a lot of things. I think ever since President Trump way back when put those tariffs on China, and President Biden kept the majority of those tariffs on, that I think that's been people saying, wow, I don't necessarily, it used to be, oh, let's go say we have a factory in China and everyone would love you for it because you have the lower labor cost and you can deliver. Now it's the insourcing, and the U.S. government for the semi factories is paying, Taiwan Semi to build, I think, a factory in Arizona, and Intel's building a huge factory in Ohio too. So that's a positive. But the interesting thing about that, we're building all these factories. So at some point there's going to be an oversupply. Don't know when, but at least those factories are in the United States, or in a lot of us also. Mexico's actually getting a little more interesting now because they're going to Mexico where there's cheaper labor, but it has the NAFTA agreement, so it can go over into the United States easier.
Yeah. The thing is though, is that it takes a long time for them to build these factories and for it to ramp up. Let's see if you fast track approvals. How long would it take for these things to really transpire and hit the economy? It's almost like the reverse of what happened in the 90s, right? I think there was a book called Alexis and the Olive Tree, and it talked about the flattening of the economies globally, where we can kind of cherry pick and outsource to China and all that. It almost feels like we're kind of doing the reverse of that. I understand it because we're like, oh, we can control our supply lines if we build it here locally.
Right. Well,
you
there
know?
is a fear. I mean, there is the risk of the politics. Like most of your clients are probably aware of the bill that just passed with Ukraine and Israel and Taiwan. But there was that. Remember, there's that little fourth little amendment, which was TikTok, that basically is going to get, was now it's because it's tied to those three. The president's going to sign it, and it's basically, I think, giving 60 days or maybe it was 6 months, I forget, to sell TikTok, which is a Chinese owned company. Does China do something to, tit for tat? Do they sit there and say, hey, Apple, you can't do X, or
Right.
who knows what is, but that's the concern I have, is that they're we haven't seen that kind of governments fighting each other, which is, that's a risk out there. I don't think it's not my primary card, which the directions, but that is a risk we are concerned about. We're concerned about that with Apple. We're concerned about that with Qualcomm. Anyone where they have 50% of their sales into China, it's a risk that you definitely have to consider.
Okay. Well, speaking of risk, does presidential election years create a another risk that you keep in mind of when you're
Um,
making your investments?
Ironically, president years are historically a good year. So, and if you think about it, not that I'm going to be not prudish, but realistic, the government that's in power tries to turn on all the spigots to help themselves get elected. So that's all I'm going to say. And I'm not going to say whether it's a
What,
Democrat or Republican.
John? No. You mean politicians try to be self-serving? Are you kidding?
So, but that's what tends to, so the economy tends to do well. I mean, case in point, I mean, I would say that a national security concern, we should be refilling the SPR, the Strategic Petroleum Reserve. It's at multi-decade lows. We have, I think there's only one reason why we haven't done that, because if we would do that, we would know people would be paying 50 cents to $1 more per gallon at the pump, which not going to happen this year. Let's put it that way. If he has anything to do with it. So not that I'm lying, I'll be quiet. I don't get
Yeah,
myself.
no. Well, here's the thing is that, I mean, I always want the truth, right? Maybe there's some scary stuff out there I don't want to know about, but yeah. So
Well,
navigating all of
let me
that.
say one thing. I mean, I'm not trying to be too gloomy. I look at investment cycles in a 10-year period, and there's usually three distinct periods. There's the 1 to 2 years where the market is in trouble, dramatically down, or you want to be out of the markets. There's 1 to 2 years where there's a back and forth where the market's trying to decide itself. And then there's usually the 6 to 7 to 8 years where it's sort of steady, clear selling. I think we're in that 1 to 2 back and forth period. And I'm actually thinking if we can avoid a recession, which that's our call right now, we're moving from that 1 to 2 back and forth period to a clear selling period. Before we would get significantly more positive is if the earnings expectations would come down. If Mr. Market would sit there and say, no, we're not going to grow 15% for the next 2 years, we're going to grow more like 8%. If that would happen, it probably means the prices are coming back a little too. But that's an area where you got all the expectations. You don't want to, you want to buy things with low expectations. That, or when you give a gift, you want the person to have a low expectation. So when they get happy. You don't want a high expectation in your gifting. That's not work. That doesn't work. So it's the same thing with the market. You want to buy at low expectations and sell it when everyone has high expectations for it.
Yeah, makes a lot of sense. Yeah, I mean, I do that with my wife. I like try to make sure her expectations are very low, so I look like I do a good job. Any other parting shots here?
The only thing I would say is we think it's probably going to be a more volatile period than the last 10 to 15 years. So I would say clients or people need advisors like you to keep them in the game, to keep a retirement plan in place, to keep them focused. Don't watch CNBC, because 1 week CNBC will be positive and they'll put all their money in, and the next week CNBC will be not that I'm criticizing CNBC, but the next week the talking points are all negative and they'll pull all their money out. So I think that's one thing, is be invested for the long run.
Yeah. Easier said than done. When you and how it feels is like when you see how it feels is when you see your statements go down But what we try to do, and you know this, is like look at a global picture for the client. Hey, what are some things that you can control? Talking about the client and spending. What we try to help with is income distribution from where it goes to, or if they're saving, where is it most give the biggest impact, both tax wise and after tax wise. And we try to work within that, and then let you guys navigate all the complexities as far as the investments are concerned, from a risk adjusted standpoint. And we found that that's been a great partnership in being able to deliver value to clients, to help them live their best life, whatever that may be for them. Because
Well,
I don't want them
I always
watching.
say, oh, sorry, go ahead.
No, I mean, I don't
I
want.
always say, my goal is so, I look at things or invest in ways so that your client can sleep at night, so that you can sleep at night, and so I can sleep at night.
100%. That's right. I don't work well off of not that much sleep. I'm just saying, right? But yeah, I mean, when we have conversations with clients, like let's say I'm talking to a client, hey, when you're visiting the grandkids or you're going to Paris and taking those vacations, knowing that, hey, we looking at the overall picture, we're working with John and his team, and they're thinking about all these different things, so you don't have to. Yeah, it works well. At a very lower level, when I go home and the yard is cut, the grass is cut, and the bushes are trimmed, I'm like, that's good. I mean, I outsource that.
I
And so I
understand.
don't have to, because I
I
don't like
understand.
it. I mean, that's just flat out something I don't care. I don't care to do. And I wouldn't be as good at it. So anyway. All right. Hey, John, thank you so, so very much for
Oh,
your
this is great.
help.
I always have fun. So
Yeah, we have a good time. We have a good time. But all right, thank you very much. Looking forward to chatting with you again in the near future. And if you get questions or comments, feel free to reach out to us over here at Riverbend Wealth Management. Have a great week.